So I think we'll maybe just get started now. It looks like that's the numbers. Everyone's here. So good afternoon, everyone, and thank you so much for joining us today. My name is Kitty Napier, and I'm an Associate Financial Planner based at our Tilney Aberdeen office. And the bulk of the content will be presented by my colleague Nadia Atanasov, a financial planner at our Edinburgh office. I'm not sure if you can see her, but I think she's going to pop up now to say hello.
Hi everybody, hopefully you can see me now.
We would also like to thank Leila and Claire at Sila for allowing us the opportunity to speak to you all today. I'm so glad that you've all logged in to hear about how making small changes to your financial situation can help you reap the benefits in the longer term. As mentioned in our invite, this webinar has been specifically designed for Sila members, people who are in the early stages of their career and accumulating wealth. With this in mind, please feel free to ask questions throughout the presentation. At the bottom of your screens, there's an option to ask questions, and we've provided some time at the end. So we'll aim to answer all of them, but it might be a good idea to include your name so that we can contact you afterwards in the event that we've run out of time. This slide is something we must include at all seminars and webinars. It just confirms that we won't be giving any advice, recommending any courses of action, and to let you know that investments can go down as well as up. For tailored advice, please do get in touch after the call. I will now pass you over to Nadia. Nadia joined Tilney in early 2019, having entered the industry through a top accountancy practice in her hometown of Belfast. Nadia advises individual clients on all matters with a particular interest in tax planning advice, and she's also heavily involved in the Tilney Young Professional Network.
Thank you, Kitty, and to everyone who is on the call and joined us this evening. So over the course of the next 35 minutes, I will explore workplace pensions, and particularly why looking at the underlying investment strategy is so important, and also how furlough may have impacted your savings towards retirement. I'll also cover various key points on how to boost your pension in retirement. I'll then look at lifetime ISAs, their benefits, and some key differences when compared to the Help to Buy ISA. I'll also look at employer benefits and protection policies and how they're important in your overall financial plan. I'll then explain a few ways of how Tilney can help if you are looking for some bespoke pieces of advice. So as Kitty mentioned, please feel free to ask questions throughout the webinar, and we'll try and answer as many as possible after the end of the presentation. So you'll see the pink circle on your screen. So as I was researching for this webinar, I came across a statistic in a Scottish Widows report that states that 51% of people aged between 22 to 29 have done absolutely nothing about their retirement. So I'm so glad that you've all tuned in today so we can figure out together how best to plan for our futures. So I've started with pensions today because, according to the work of many psychology journals, starting with the hardest thing first makes everything else seem a lot easier. And I think my friends and family are actually sick of hearing me talk about investing and pensions. But to be honest, the only reason I chat so much about them is because they're so important, especially for us younger people. It's so important to know what is going on with your pension, and you'll thank your future self for paying attention and making changes, small or large, to it. So nowadays with auto enrollment, provided you have sufficient earnings, you'll be enrolled into a pension automatically, usually after 1 to 3 months, and you're usually set up to pay the minimum standards set by the government. So that is 8% of your qualifying earnings, with your employer having to contribute 3%. You usually go into a default fund, and it's usually medium risk, so your individual needs and your individual appetite for risk is not considered. So I ask you to think now, do you know what your pension is invested in? And have you looked at the asset makeup of your pension fund and the performance of that over the last couple of years? So when I come to think of my own personal situation, I'm 28. So based on current legislation, the earliest that I'll be able to access my pension is in 30 years' time. So when I'm 58, so imagine it gets to 15, 20 years down the line, and I sit down with a financial planner and I start paving a route towards my retirement. But I find out that my pension has returned next to nothing. It's barely kept up with the impacts of inflation. So that's 15 to 20 years of potential growth that I will have missed out on simply by not checking the performance of my pension early enough. And I've included an example on this slide of when and how this happens. So I've included a graph that shows the performance of a fund that's used in a lot of group personal pensions. And the top graph shows the performance of this fund since it first opened, and the bottom shows the performance of the same fund over the last 5 years. So that red line is the actual performance of the fund, and that blue line is what's called the benchmark. So basically what the performance is assessed against. So if you look at that bottom graph, you'll see that red line is below the blue line. So therefore the performance of the fund has been poor in comparison to the benchmark. So it's seriously underperformed. And if you invested £1,000 in that fund, just to contextualize it, if you invested £1,000 in that fund 5 years ago, it would be worth £987 today. So you actually will have lost money by holding your money in that investment. And some pension schemes have lifestyling. And what that means is as you get older, the pension scheme switches your funds into less risky assets. And it's basically to protect your accumulated wealth from drops in the market as you approach retirement. And these switches usually occur 15, 10 and 5 years before retirement. And some of the issues with that is the switch into lower risk assets will occur irrespective of market conditions. So to contextualize that, imagine your pension scheme switched you out of your fund on the worst day in markets this year when the coronavirus hit. So it wasn't uncommon to see that funds had dropped between 10 to 15%. So you will crystallize that loss of 10 to 15% by something automatic that happens in your pension scheme through lifestyling. So if your policy is in a lifestyle model, it's very important for you to know your targeted retirement age. A, to know when these switches will occur, and B, if you do not plan on retiring at that date, you may wish to be in different investment funds. So you may wish to be in an investment fund that is aimed at more growth if you plan on retiring later, or an investment fund that will protect your capital a bit more if you plan on retiring sooner. So when we're looking at investment funds, they're usually made up of different asset classes, and I've listed the main asset classes on this slide. So to start off with the first one, shares, or as they're more commonly known, equities, is effectively owning part of a company. This asset class tends to be the most risky, so it can be more volatile in the shorter term, meaning it's more sensitive to market movements. But this asset class has historically provided the best levels of growth over the longer term, and they can be usually grouped into their geographical region. So you'll hear UK equities, US equities, Asian equities, or you can have a group of global equities which incorporates shares from all over the world. And even by geographical region, the levels of risk within equities can be different, and that will depend on the economies and sort of the political stability in each of these countries. So moving on to the second one, that's bonds. So bonds is a form of debt, usually either to companies or the government. So an investor would buy a bond, which in return would give a company or government sort of capital. And in return for that capital, the investor, so you or I, would receive interest payments from the government or the companies. So bonds tend to be lower risk and they are less volatile usually. However, there's always a risk that the borrower could experience financial difficulty and you may not get all of your capital back. There's a whole load of different asset classes as well, but just to name a few, there is commodities, which sort of invest in gold and oil. And there's also property funds as an example, which invest in large property portfolios. So when people ask me, Nadia, if you had £10,000, where would you invest it? What shares would you buy? I always tell them that is not my level of expertise, as actually like researching and keeping up to date with good quality individual shares is a full-time job. And that is a job that belongs to an investment manager. And we have a lot of them at Tilney that look at the underlying investments for all of our clients and do that on a regular basis and do that research. But you also, those pension funds that you're invested in, those funds have fund managers and they're the ones that are doing that on your behalf. They're the ones that are constantly researching the market to ensure that they're getting the best quality stocks and bond portfolios for your investments. And these investment funds that you're able to invest in will usually have different risk ratings, and that's predominantly dictated by the amount of equities within the fund. As I mentioned before, that is the riskiest asset class. So if you take an investment fund, for example, that has 30% equities, and you compare that to another investment fund that has 60% equities, that 30% equity fund will be less volatile in the shorter term, but over the longer term, it may not have as much of a return when compared to the 60% equity investment fund. So the second part of this webinar, which is taking place on the 17th of September with my colleagues Matt and Kyle, who are both investment managers in our Glasgow Tilney office, they will go into investing in a lot more detail than what I have today. So definitely tune in then if you want to find out a bit more about investments and how they operate. I think Sila will be issuing the invite over the next coming days. But as I mentioned at the start of the webinar, this has been designed with young people in mind. And as young people, we have time on our side. We can afford to take a little bit more risk, as we'll not be able to access our pension for such a long time, like 30 years for me, as I said before. So this next graph demonstrates how making small change can reap the long-term benefits. So the top left graph assumes a growth rate of 3% per annum and contributions of £100 per month. It also assumes a rate of inflation of 1.5%, and that's to give us a flavour of the true value of money. So at the end of the 15-year term of that top graph, your savings pot will be worth £20,244. So that's actual growth of £2,244. If you were to make a slight change to the underlying investment strategy, so if you were to increase the equity content and take on a bit more risk, and were able to achieve a growth rate of 6% per annum, so double compared to that last graph, the growth over the term would be £5,816. So that's actually more than double when compared to that first graph, and that's due to the effects of compound interest. And if you were to save slightly more each month and increase your contributions by £20, the growth at the end of the term would be £6,979. So it's even more. So it goes to show why looking at the performance and making changes can really help you make the most of your money. So whilst we're on the topic of investing, another thing that I'm asked a lot is, why is it a good idea to invest money when markets are deemed to be low? So there's a little art in the investment world called pound cost averaging, and this table shows the benefits of it. So when you're investing money into a fund, effectively what you're doing is giving the fund manager money in exchange for units in their fund. So if you were all to log into your pension accounts now and you were to look at the values of your pension, you'll see you'll have a certain amount of units, and you'll also have a unit price, and it's usually the amount of units times the unit price will be what the value of your fund is, and that unit price is what fluctuates with the market. So if you look at the first line of this table on your screens now, let's say if you put £100 into a fund and the current price was £1, that means you get 100 units in that fund. Let's say the next month the unit price increases because markets have went up. So you'd give that £100, but in exchange you would get 80 units. So you'd actually get less units for the exact same amount of money. And then let's say the following month the markets have dipped a bit and the unit price is cheaper, it's now at 80p. So that means for the same £100 you would get 125 units. And let's say the month after markets go back up again and you give £100 into a fund, so you would get 80 units from that £100 if the price was £1.25 per unit. So now in total you have 385 units, and the key thing now is that all of these units that you've bought are valued at £1.25 per unit. So even though 1 month the unit price had dropped lower than what you initially bought it for, the thing is the unit price came up with the market. So effectively those ones that you bought that were at a lower price, they have made the highest gain now. So therefore it's increased your profit over the time. So that's why taking advantage of low valuations in the market can potentially lead to better returns over the longer term. So hopefully that gives you a bit of food for thought for the investment side of things. But as I said, on the 17th of September, definitely log in. My colleagues will definitely go into that in a lot more detail. There's also some other key aspects to consider with your pension and how to make your money work harder for you. First off, do you know what your maximum employer pension contribution is? And do you know if your employer will actually match what you're putting in? Because it's definitely something worth considering as you're be able to take advantage of free money from your employer. So why would you not do it? Also, can you afford to increase your pension contributions? And did you know that you can actually add in more than the minimum? Because a lot of people don't know that it's a minimum contribution you're making, and you can add more if you wanted to. You could potentially open another pension account that you wanted to keep separate from your employer account if you wanted to. Salary sacrifice is another great way of getting additional funds into your pension, and it's also a great way of reducing the amount of tax, national insurance and student loan that you're repaying. And we all know how much of a burden student loan repayments are, so definitely check with your employer if this is an option for you. And how much do you know about your old pension plans? So up until last year, I had 5 different pension schemes that I was a member of, and I think one of them had a fiver in it. And it was just completely stupid just to have a pension scheme floating about with £5 in it. So I consolidated all mine into the one, and it's so much easier admin wise. So if you were to move house, for example, you'd only have to change the address on one policy, or if you were to change your name as well, you'd only have to do that for the one policy. But by consolidating them all into the one, you could actually benefit from a reduced charging structure moving forward. But it's more than likely that your employer scheme is the cheapest, so it's worth considering too. And for those that may be self-employed on the call, have you looked at taking advantage of employer pension contributions from your limited company? So according to the same report by Scottish Widows that I referenced earlier in the call, 34% of self-employed people are not saving anything towards their retirement. And that's usually because making pension contributions is last on their list, as they're more focused on paying salaries and having adequate cash flow. However, if you're able to, definitely start making pension contributions, even if they are really low, as you'll be able to reduce the corporation tax within your company. And also, if you're a higher rate taxpayer and you pay those contributions yourself, you'd be able to benefit from a 20% additional tax relief. And just to bang on about it one more time is, do you know what your pension is invested in? So that's just one of the key points I want everybody on the call to take away today, is just to figure out exactly what their pension is invested in. And if you need help with that, or you want to discuss that with anybody, please feel free to get in touch with either myself or Kitty after the call, and we'd be more than happy to help. So I have included in this webinar furlough and pensions because I know it's a bit of a hot topic at the moment, and it's one I wanted to include for SILA, as I know furlough has greatly affected the legal sector in Scotland. So I have been consulting with one of our technical specialists at Tilney to try and get the most up-to-date information on how furlough has actually impacted the pension scheme contributions. So the information is based on group personal pensions rather than defined benefit and final salary schemes, as I feel there's a lot more people that we reach to on this webinar. So the JRS, which is the Coronavirus Job Retention Scheme, has been paying 80% of pre-furloughed salary, capped at £2,500. They've also been paying your employer's national insurance contributions and also pension contributions, and that was up until the end of July. So the JRS is still paying furloughed salary at the moment up until the end of August. However, for August, it's changed now that your employer has to pay their own national insurance contributions, and they also have to pay your pension contributions now as well. So that's any employer pension contributions. So from September, the JRS is actually starting to taper down the amount that they're paying with regards to furlough salary, and your employer has to make up that difference up to the 80% mark. The employer still has to pay their national insurance contributions and their own pension contributions as well. So with that, there's a few considerations for pensions and how the contribution rates may have changed. So the first off is, as people have been furloughed, there has been a reduction in salary. And did you know that that actually had affected your pension contributions? It's definitely worthwhile looking at that and potentially topping it up from your own pocket if you're able to. As I said before, there is a minimum amount that must be contributed, but you're also able to add in more than that if you're able to. There's also, with regards to auto enrolment, there is a minimum salary threshold, and that is in order to qualify for auto enrolment, and that is £10,000. So if because of furlough your pay has fallen to below this, it may affect your eligibility within the pension scheme, but it also may affect your pension contributions moving forward. So if that does apply to you, definitely get in touch with your employer and see what has happened with that and if there's any changes to be made. And as I said, from August 2020, your employer is now liable to pay their employer pension contributions on your behalf. So it's worth bearing in mind that they're only legally liable to be paying the minimum 3% for auto enrolment. So if they were paying more than that before, it could be that they reduce that now moving forward, just with everything going on in the global economy. But it's worth bearing in mind that they need to get your written consent before that if they're going to make any changes. So just to keep that in mind moving forward. And finally, from being part of salary exchange, you may have lost out on contributions just by the virtue of the way it's calculated by the JRS. So definitely check that to see if your contributions into your pension scheme have changed. And as I said before, if you're able to top that up, it's definitely worthwhile doing so. So the last point I'm going to say about pensions is probably one of the most important. So as society changes, our generation is definitely becoming the generation that will receive hardly anything in the form of a guaranteed secure income in our retirement. So we are at the mercy of investment returns for the foreseeable. Long gone are the days of final salary pensions that like our parents and our grandparents have that'll pay them an income up until the day they die. So we'll never get that anymore usually. Apart from if you're in the NHS or a teacher, for example, they're part of that scheme. And also the state pension age is increasing every single year, and who knows whether we're actually going to get one, because at the moment it's being discussed as it being mean tested moving forward. So on that lovely note, let's move on to our next topic, my beloved Lifetime ISA. And the reason I say my beloved Lifetime ISA is because I love talking about it to all my friends and family. So the first thing about it is it's free money. So basically the government gives you 25% up to a maximum of £1,000 per year on your maximum contribution. So the maximum contribution you can make into a Lifetime ISA is £4,000 a year. So you can put that in as a lump sum, or you can make regular payments if you want. So I started mine up with just £25 per month. So if you are planning to save towards a house, it's definitely worth considering opening a Lifetime ISA and getting that bonus and using that towards your house purchase. But it's worth remembering that you can only use that bonus towards a house purchase if you are a first-time buyer. And unlike the Help to Buy ISA, all of your savings in the Lifetime ISA, including the bonuses, can be used towards your house deposit, which I know is the hardest thing to save for. And the third point is particularly relevant for those in the Edinburgh area, as the average selling price of a home in Edinburgh and the surrounding areas was just over £253,000 in 2019. So if you actually had a Help to Buy ISA, you wouldn't be able to use your bonus against the purchase price because the purchase price was over the maximum amount. However, if you had a Lifetime ISA, you will have been able to use all the bonuses for that because the maximum house purchase price within a Lifetime ISA is at £450,000. There is also a penalty of 25% if you withdraw funds from the Lifetime ISA outside of what is permitted penalty free. But for me, I find that as a bit of a positive thing, because if you're a bit like myself and you find it hard to compartmentalize between like what is actually savings and what is excess money in the bank account, knowing that there's a deterrent, it really helped me to save towards my goal of getting a house. You must have held the Lifetime ISA for a year before being able to use the funds towards a house purchase. So that includes if after this call you decide that you want to open a Lifetime ISA and transfer your Help to Buy ISA into that, you still need to have held that Lifetime ISA for a year in order to be able to use it towards a house deposit as a first-time buyer. And this next point is quite important. So there is actually two types of Lifetime ISA. There's a cash Lifetime ISA and also a stocks and shares Lifetime ISA. So I've been chatting to some family members and also some prospective clients recently that have been contributing into their Lifetime ISAs for years, but they didn't realize the contributions were going in and just literally sitting in cash. They didn't realize that they were going into a stocks and shares Lifetime ISA and that they had to select an investment within that. And the reason why that's so important is the interest rates in the cash account of a Lifetime ISA is absolutely abysmal. So mine, for example, is earning interest of a big fat 0.00% per annum. So if you consider the rate of inflation that is effective, your money's basically eroding every year. And if you tie that into the fact that in Edinburgh, the average price of a house has been increasing 3.4% every year over the past 5 years, you're really making it harder for yourself to try and make your money work as best it can. And the final point is really just to highlight that if you are looking at starting to save, but you're not sure exactly what your plans are, you're not sure whether you want to buy a house or whether your goal is to save to go on holiday, you're not sure whether you want to tie up the funds or whether you want to dip into the funds. If you know at some point you're going to be purchasing a house, I would definitely look at opening a lifetime ISA and potentially adding funds into that, because it will really help if you are a first time buyer. But also having a pot of savings on the side as well that you may need to dip into in case of any unforeseen circumstances. It's great to have a cash buffer. Like for me, when I go to get my MOT done, for example, and I realise that it's came out £300 that I need to pay the mechanic, and it's just such a stress, but knowing that you have a cash buffer behind you can really help alleviate that. But it's just ensuring that you're shopping around and you're getting a good interest rate on that cash savings that you have to try and combat a bit of the rates of inflation. So the next part of the presentation is on employer benefits and some useful tips with that. So I've listed some of the main benefits employers will offer and some things for you to consider within each of them. So if you are able to take these out through your work, I would strongly suggest you do so. The deals you can get through the company are usually a lot cheaper than if you yourself were to go directly to an insurance company or if you were to go through an insurance broker. And usually the premiums towards these policies are tax deductible, so it can save you on tax and national insurance, but do check with your employer to see if that does apply within your company. So let's say you owned a money machine and that money machine paid out 20, 30 or 40,000 pounds per annum. Would you insure it in case something happened to it? You are that money machine, and everything you are, everything you do, and everything you want to do depends on that income that you are generating. So if you're happy to insure your car, your cat, your phone, then why would you not insure yourself? And the main reason people do not take out insurance is because we're so positive, we're so optimistic, and we never think the worst will happen to us. But from experience, it's only really when people start to have families and they start to have kids or they're caring for the elderly relatives, it really dawns on them how valuable life is. But I've used myself as an example here on the left-hand side of the screen. So if you're single and you're 28 and suddenly you're to be diagnosed with an illness that left you unable to work for months, there's a 33% likelihood of that happening to me before I retire. So I ask you all now, do you know what your sick pay is? And do you know if you even get sick pay through your work? Do you know how long your sick pay lasts? And have you checked the levels of statutory sick pay? And do you know if that would actually cover the bills that you have every month? And I've used my colleague Ali as an example on the right. So if you are a smoker, there is the likelihood of these things increases. So there's actually 22% likelihood of him getting diagnosed with a critical illness before he retires. So if he were to have a stroke and unable to work again, how could he afford to live? If he was unable to walk again and he had to use a wheelchair, could he afford to stay in his flat or house, or would he have to move, or would he have to adapt it to meet his needs? And does he know actually how much that would cost? So these are things to consider, and they're so important to look after, number one, and to ensure you have yourself adequately protected. And the earlier you start and you take out these premiums, the cheaper that they are ongoing. However, it's so important to review these on an annual basis, because obviously now we're at the start of our careers, and as we hope to progress through our careers, hopefully we'll be earning a bit more money. So to ensure that you have these insurance policies in place, that they're providing a level of cover suitable to meet your needs as you do progress through your careers. And also, as we do move through the stages of our lives, it could be you take on a bit more debt if you were to buy a bigger property, for example. So ensuring you have an adequate amount of life cover in case anything were to happen in that respect. So finally, how we can help you here at Tilney. So we bear the cost of our initial meetings, and there's no obligation at all for anything to come out of these meetings. So if there is anybody who's looking to have a chat, please feel free to drop me or Kitty an email after the webinar, and I'm more than happy to get back in touch to arrange time to have a chat. I've listed a couple of things that sort of spring out in how we've helped people in the past of this sort of the younger professional generation, but this list is not exhaustive. There's so many other areas that we can help with. So one of the things that we've helped with before is looking at your pensions. So we can look at your current pension scheme, we can look at some of the previous ones you've had and track them down for you, and also discuss any courses of action if suitable. And we can also provide overviews on pension schemes and provide you with and sort of let you know the benefits of each of these pension schemes that you may have. And additionally, if you realised after this call that you do have a lifetime ISA and it is sitting in cash, we're able to help with recommending a fund for that if that's something that you want to pursue. And also, I often find with people, like when you're having a chat with them, sometimes they want to start investing, but they just don't have a clue where to even start, where to open an account, or what fund to invest in, how much to invest, like what are the rules about it. So if you log on at the 17th of September, my colleagues Matt and Kai will go through that, actually how to open an account and what sort of things to be looking for. So definitely log in then. And we're also more than happy to review your protection needs and identify if there are any gaps in coverage. And sometimes people can be overinsured and you may be paying more than what you actually need to be paying for your insurance. So we'll definitely assist with any replacement cover if that's needed, or alternative cover if suitable also. So to summarize from me, I think not just because I am part of this younger generation, but these years of our lives are so different. Everybody's just at different stages of their lives, whether they're getting married, whether they're getting divorced or starting families, or whether they're buying property or renting as well. So we're just all so different. It's such a tough time. But the thing to consider is what you want to do with your money is up to you. So you need to consider your own individual goals. Like, when are you likely to achieve these goals yourself, and whether you're happy to tie up money, for example, or whether you want access to it, and what exactly you're using that money for. And that can really help influence your underlying investment strategy if you were to pursue an investment. It's just so important to look at yourself and your own individual needs and just to plan it out, but to first and foremost ensure you're adequately protected in case anything were to happen to you. And second of all, to ensure you are doing the best you can with your money to make things more affordable to you in the longer run. So everybody is different and there's no right answer, and the point of living is just to enjoy it. So I will end on my philanthropic note and pass it back to my colleague Kitty.
Thank you, Nadia. I hope that everyone got something from that and can see how just a small change now can make a massive impact in the future. So thank you for all the different questions. Our first question is from Anonymous, and it says, I have an extra £200 a month. Should I be saving this into my pension or my ISA?
Yeah, this is something we actually get asked all the time. It really does depend on your individual circumstances. So if saving towards retirement is really important to you, definitely put that into your pension if that's what you wanted. However, you need to consider as well what your sort of short-term goals are as well, or whether you need to build up that cash buffer, or whether sort of you have kids if you want to save towards them, or whether maybe saving towards university costs and different types of studying. So it's definitely an individual thing that we'll need to assess. So if whoever that is, definitely feel free to drop me a line, and I'm more than happy to take this offline and have a sort of a more personal, tailored conversation with you, because it's really all about what drives you and what you want to do with that money that you're saving.
Great. And that actually leads on to another anonymous question here. And it is, would you pay extra towards your pension, or would it be better to set up your own stocks and shares ISA and contribute to it as your own pension fund? Thinking about paying tax now over paying tax at retirement age.
Well, that is a very good question. The thing with pensions is you automatically get 20% back. So as basically a taxpayer, if you're putting funds into a pension, you get 20% back. If you are a higher rate taxpayer, you get an additional 20% on top of that. And if you're a higher rate taxpayer, you get additional 20% on top of that. And if you're an additional rate taxpayer, you get an additional 25% on top of that. So these are the automatic tax rebates you get through pensions. So obviously that is a tailored question as well. I would love to speak to somebody offline about that to talk through that, but generally we would always advise to put money into a pension scheme if you are saving towards retirement, because of the amount of tax rebates and tax relief you can get at the moment. And that is something that's being talked about at the moment of government reform just due to the levels of tax relief people can get moving forward. So feel free to drop me a message afterwards if it's something that you're looking at and something you want to consider yourself.
Perfect, thank you. So Anonymous, please do contact myself or Nadia to get a little bit more information on that. And another ISA question is from Ian. If you take out a lifetime ISA at 37 years old, does that mean you can only benefit from the government contribution for 2 years and therefore a maximum of £2,000?
Yeah, I'd need to double check the rules on the lifetime ISA after the call, and I can get back to you on that. I think, if I remember correctly, you can only get the tax relief up until the age of 40. And then I think the funds can remain invested up until 50, which can take them penalty free. But that's something I'll definitely need to double check after this call, and I can drop you an email with further information on that, Ian.
Yeah, that's my understanding as well, but we'll definitely get back to you, Ian, and confirm. I think we've got another question here from Christy. Should I be putting money into a savings account when interest rates for saving accounts are so low?
That's also a very good question, Christy. Yes, interest rates are absolutely shocking at the moment. It's so hard to even try and find anything that's paying over 1%. And if you think of inflation, inflation is due to increase from what people are saying and forecasting with the economy. So at the moment, I think inflation is sitting at about 1.8%. If you're getting anything lower than 1.8%, the true value of your money is being eroded on an annual basis. So the thing is, if you are putting money into a savings account, it's thinking about what you need that money for. If you need instant access to that money, then there's no point in you tying that up into an investment, because at the moment markets are so volatile, they're going up and down. And usually if you are making an investment, we would advise for it to be on a longer term, so be 5+ years. So it's kind of thinking about your short term, medium term and long term goals of what you want to do with that money. But Christy, if you want to pick up with that separately, I'm more than happy to talk you through that and see the different rationales of where and how you would put your funds.
Great. Now, it seems like there's a common theme here of things being kind of very particular to the individual. And we've got another question here of, can you please tell me more about the next webinar and when it will be?
Yes, so I suppose that's a good note to end on. So I think we're running slightly over time. So the next webinar is going to be on the 17th of September, and that's with my 2 colleagues, Kyle and Matt, who are both investment managers in the Glasgow office. So what they're going to do is sort of a back to basics type webinar, and what they're going to go through is the whole shebang with investments. They're going to look at how to start investing, what investing is, what investing actually means, the different sort of asset classes, and what they do and how that fluctuates with the market and things like that. Another thing I think they're going to consider as well is ethical investing and the benefits of that and what that actually means when you're looking at ethical investments. What is sort of the underlying stocks and shares and how companies are actually selected to be ethical, as they say. So that is what's happening on the 17th of September, but there should be further details coming out about that after this webinar. So Sila will definitely be posting that on the social media accounts, and I'll be sharing them through LinkedIn as well. So I think that is probably a good place to finish, Kitty. I think we've slightly ran over time, but if there are any other questions, I'm more than happy to take them offline and get back to you if you've provided an email address.
Perfect. Thank you very much, everyone.